Hello and welcome everybody to this particular session. Today, I want us to look at the fears or the conversation that has been going online about the likelihood of the U.S. economy entering into a recession. And let's digest and look at some key data that will basically guide us in terms of understanding whether exactly we're going to see a recession in the US economy or not, right? So my name is Timothy Carey, your research and market analyst. So let's dive into the business of today, okay? So the topic is the US economy headed for a recession, right? That has been quite some key conversation that has been going on online, and today we want to look at some key data that will guide us in terms of understanding this particular topic, or whether we are going to have a recession or not. Right? We have seen a lot of recession worries which are spreading, but again, if you look at different analysts, all analysts are basically scattered. There are those who don't expect economic slowdown in 2025. The others who are looking at maybe probably growth to reaccelerate next year. So which is which, right? And you find now that with the heightened risk factors, like maybe probably the rapidly cooling labor market, which means the economy is more vulnerable to a negative shock. But again, what does the number says, right? We have seen the story of the tariffs as well. Trump tariffs, which still have the potential to weigh down on growth, because what we have now, we haven't received the ruling from the Supreme Court. So the Supreme Court of the United States is the final. Once it makes the ruling, that ruling will be final. And already evidence has been presented. The hearings have happened. What you are waiting now is for the ruling, whether Trump tariffs are illegal or not, right? So, but the main debate about the tariffs was, even for the reason why it went into the court, was they argued that Trump was basically acting or he was acting above the powers that he has as the president. So he doesn't have the powers basically to issue the tariffs or something like that. So that has been the argument. But like I said, we are still waiting the ruling by the Supreme Court. All right. So to begin us today, the key themes that we shall be looking at, so that we can understand these, we'll be looking at the current growth and GDP. We'll be looking at consumer spending and sentiments. We'll be looking at some key data on labor markets and inflation. Also, we'll be looking at some quite interesting data on monetary policy and interest rates, as well as the yield curve and the market signals. All right. So let's start by looking at the GDP. So when you look at what we have, the figures we have in terms of the GDP, so we have been seeing. We have been seeing for the GDP, we have been seeing the graph for the GDP about somehow we have been seeing some mixed sentiments. All right. I remember the first quarter we had a negative data for GDP, which came out at about negative 0.1. Was it for Q1? Yeah, we had a negative 0.1, and these actually even increased more risks for recession, right? So, but now when you look at the GDP, the US real GDP, yes, it has contracted in the first quarter, which it contracted by around first quarter of 2025. It contracted by around 0.3%, right? So the contraction was actually driven by an import spike, right? That is companies stocking up ahead of tariffs rather than the broad domestic collapse. So despite this, you realize that it doesn't yet signal a full-blown recession. Okay, so when you look at some of these key data here, we see like in Q2 2025, it was able to grow to 3.3%, right? Actually, Q1 2025, it was about negative 0.5%. Then in Q2 2025, we are seeing 3.3%. And when we look at maybe probably the GDP for Q3. Let me see that whether we have that. Just give me a minute, right? So because there are some data which were not released, and so let me check that real quick. Let me try get that so that we can have facts for this. So this is the US. All right. Yes. So this is all right. So um, hmm. So let's just a minute. So when you look at that, actually, I've been seeing quite some very uh, uh, numbers actually from negative 0.5 coming to 3.3 for Q2. So let's just getting the final GDP. Yeah. So the final GDP for Q3 was 3.8%. So Q2 was 3.3. Q3 was 3.8%. So we are seeing an increment in terms of our growth, in terms of the US economy. But I expect now that we have been having a government shutdown, not much activities have been happening because of lack of funding. Maybe probably in case when now, because the US government has reopened, we might now start seeing some key data for the USD. Of course, maybe probably you might see the contraction of the GDP as a result of the same. Okay, so now when we start looking at consumer spending, all right? So when you look at consumer spending, basically, what are we talking about in terms of consumer spending? You realize that um, in terms of consumer spending, this actually comprises of about less than 70% of the US GDP. So, being the largest component of the economy, it is one of the biggest determinant of countries' economic health, right? It is one of the big determinant of countries' economic health. So as you can see from this particular chart, we can see from maybe probably Q1 2025, the percentage change from the preceding period grew by about 1.8%. So we saw about 1.8%, and that is in Q1 2025. And however, consumer sentiments dropped significantly because you are seeing a drop. The previous one, it was about, if we look at the previous one, that is Q4 2024, it was about 4%, right? And Q1, we see about 1.8%. So actually, the entire of Q 2024, we saw an increment from 1.9, we went to Q2, 2.8, Q3, 3.7, Q4 to 4%. Then in 2025, we are seeing a reduction of the same, of course, with the impact of the tariffs being implemented. And so we are seeing it change from 1.8% for Q1. If we look at Q2, let me see whether I have Q2 with me. So that is consumer spending. Let me try get that consumer spending. So just a minute. This week. We see whether we have that data here. So, but we have been seeing that decline in terms of consumer spending, right? In terms of consumer spending. So I'm not looking at consumer sentiments, but I want to look at, so when you look at the sentiment, let's first of all even look at the sentiment. So consumer sentiment, the data that was released in October 10th basically shows the consumer sentiment reducing from 55.1% to 55.0%. So it reduced significantly. If you look at how the data was sometimes around June, we were talking about a figure of above 60, right? June 13, we had 60.5. July 18, we had 61.5. Then we saw a reduction in August 15 to 58, and in September 12th, we see another reduction to 55.4, and then on October 12th, October 10th to 55. So we are seeing a reduction of the same. So, but cumulatively, quarterly, we are seeing that reduction, and this is one of the sentiments why people are talking about a weaker US economy, because you're seeing the reduction of the consumer sentiments, right? So what basically we are talking about, if we are seeing consumer sentiment dropping significantly, because we are seeing data shows a decline in terms of consumer spending, all right? So what now, this basically shows that consumer feel pessimistic, all right, even though the spending hasn't really fully collapsed. And the key question now we can be able to ask ourselves is, will spending follow the sentiment downward, all right? Will the spending, because the sentiment is downward now, will the spending basically be able to follow the sentiment, all right? So that's the big question. That's what we'll be anticipating. I know a bit of these third quarter and the fourth quarter, we have not been able to receive the data for that quarter because of the government shutdown, and that again creates a lot of uncertainties. All right. So when you look at the labor market and inflation, you realize that in the labor market, we can begin by looking at a different set of data, like for instance, the monthly change, right? So we are seeing a labor market slow, right? A slow labor market. Let me pull out the data for this. The labor market, that is the NFP. I know we haven't had the NFP of late, right? We haven't had the NFP of late because of the shutdown, right? Because of the shutdown. So let me get hold of that data, right? Let me get hold of that data. So the last NFP we had was it in September? I think that's when we had our last NFP. So yes, it was in September, and we saw a decline from 79k to about 22k. That was reported on September 5th, right? So when you look at these particular data, we have, what I have here is until August, right? Whereby in August, that what was reported, actually what was reported in August is what actually was reported in September, right? The data for August was what was reported in September. So we haven't had any other because of the government shutdown. So just basing on this, because what we have here, this is the August data, right? This is the August data here. So, and this shows about 22, right? Shows about 22k. Basically, the last average in the last 3 months, basically that's what forms a quarter. We are talking an average of about 29,333, right? So if you look at the previous one that we had, it was 79k, all right? Then we had the June at 13k, negative 13k. Then we had the May from 19 at 19,000. So if you begin looking at what we have from the month of Jan, Jan we had 111k, Feb we had 102k, March we had 120k, April we had 158k, and from there we have been seeing quite a decline in terms of the labor markets. All right, um, so what does that mean? This basically shows that the labor market is actually more vulnerable today than at any point in this expansion, and therefore, workers. This shows that workers are feeling some a bit of pressure because of some bit of pressure, especially for the monthly payroll growth, because you can see the monthly payroll growth is quite shrinking. Okay, so the labor market, we are seeing some bit of shrinking there. So also when we are talking about the labor market, it's good also to look at the jolt hiring. All right. So when you look at the jolt hiring, I think we are standing at 3.3%, right? About 3.3% for the jolt hiring. I think for the JOLTS report, did we have it this other month? Let me check. The last time we had that data, right? September 30th. Let me check real quick so that we can discuss facts here. So jolts. So for jolts, I think the last one we had was on September 30th, and so on September 30th we had the jolts data, which stood at 7.3 million, compared to the revised figure of 7.21. Right, so it's basically um, uh, um, like steady, right? We can say it's basically steady. So in terms of these, what it shows, basically we are seeing when you combine now the non-farm payrolls and the jobs report, what we are seeing is low hire and low hiring spectrum, whereby there is less hiring that is happening in the US economy, right? So the moment we are standing at for July, in terms of number of new hires per month as a percentage of total employment, we are talking about 3.3%. This is in July. If you look at maybe probably in the month of June, we had about 3.2%, right? In September, we talked about September. Let me begin from maybe probably Jan 2024, right? Jan 2024, we are talking about 3.5. Then we had a decline all the way to June where we had the 3.2. Then we saw an upward in September where we had the 3.5. In November, we had 3.2. And when you start looking at probably this year, we are talking about uh, 3.3%. So as you see this, probably this graph as it looks, we are seeing a push on the downside, right? We are seeing a push on the downside. We had a spike here in that was around May 2020, where we had about a 6.1%, right? So that's what we are seeing. So we are seeing quite some sluggishness, especially in terms of hiring. Okay, so if you look at inflation data, we are talking about um, inflation being above the central bank target. The target is 2.2, approximately 2%, right? So, and where we have the moment the data that was released, we are talking about 3%, right, in terms of inflation. So we are seeing quite a stubborn inflation, right? We are seeing quite a stubborn inflation. Core inflation about, let me check that. The last one was about 2.8%. So let's check that real quick. We had the CPI released on, yeah, the last one we had here was on October 24th. October 24th. So the core CPI monthly at 0.2%, which shows a slight reduction from the previous one. So the CPI yearly from 2.9 to 3.0%, again showing some bit of increment. So we still have quite stubborn CPI or stubborn inflation. So still on the employment. So when you look at the unemployment rate, what we are seeing here is that at the moment we can say that an unemployment rate is a bit steady, right? There's not much change, right? So because the last one for August 2025, we are talking about 25. I mean 4.3%. Okay, so it's standing at 4.3% August 2025. So in June, you had seen 4.1, 4.2 in May, March 4.2. So it's a bit steady. From Jan, we are seeing 4.0 percent. So it hasn't gone above 4.3. So from 4.0 to about 4.3%. So what you can say is that yes, we somehow, if you look at the entire graph here, we see the entire this graph. What we are seeing is a steady declining supply and demand in the labor market, which means the overall unemployment rate hasn't really changed much over the past few months, right? Especially in this year, and that's quite a key thing to look at. Why? Because we aren't seeing massive amounts of layoff, right? So if layoffs do materialize, then we expect them to affect the smaller and mid-sized firms more than the larger firms, and therefore, with this kind of unemployment rate, right? With this kind of unemployment rate, also it raises eyebrows in terms of the likelihood of the U.S. economy maybe probably entering recession, right? So before we wind up, it's also good to look at maybe probably we look at the monetary. Before we look at even the monetary policy and interest rates, is good. Back to labor markets and inflation, it's always good to understand that what we are seeing here is a balance: strong labor, moderate inflation, basically which reduces immediate recession risks. But policy space is also looking constrained. All right, the policy space is looking constrained. But let's now jump into the policy, the monetary policy, and the interest rates, so that we can be able to understand this. So we have seen the Federal Reserve basically being able to lower the rates. There's been a lot of pressure from the President of the United States of America, Donald Trump, and we have seen so far so good this year, at least 50 points basis cut. We had the first one around, was it in September? When was the last meeting? Central bank. Okay, so let's see the central bank. So I'm looking at, just a minute, the central bank. Yeah, so when you look at the central bank here, so we saw the last meeting, right? The last meeting was quite significant because we had the first rate cut at September 17th, from 4.50% to about 4.25%. That's 25 basis points. Then again, in October 29th, we saw a rate cut by 25 basis points. Right now, we are standing at 4.00%. And what we are still anticipating is to see another rate cut by the Fed come before the end of this year. We still have those anticipation. We are likely to see another 0.25%. But now we have been having a government shutdown. We haven't seen much. We haven't seen much activities. We haven't seen much activities that has been happening, especially with now that we have been seeing the government shutdown in the US. All right, so what does that really mean? So when we see these kind of scenarios whereby we are seeing the rate cut, of course, when we have a rate cut, then it means that the dollar index is being pressured, right? There is a lot of bearish pressure or selling pressure or weakness in the dollar index, right? And what we really See, because the dual mandate of the central bank is to ensure full employment and stable prices, which complicates the decision when growth slows but inflation remains elevated. So it's kind of a confusing element. They are cutting rates, but the interest rate is still. I mean, they are cutting the interest rates, but inflation is still stubborn here. Okay, so key to understand, maybe probably when we talk about now the likelihood of a recession. So how do we determine maybe probably whether we are likely to see a recession? So from these kind of data that we have seen, do you think a recession is imminent, right? Do you think a recession is imminent? So from what I'm seeing basically now, giving my own sentiments according to these data, is that the economy, the US economy is still somehow expanding, even though we have had that sluggish growth, especially this time that we have the government, we have been having the government shutdown, but we are not yet seeing the contracting aspect of it. But the momentum now, it's growing. Yes, we are not seeing the contraction, but the momentum is weak. The momentum in terms of how it's growing is weak, and this raises more high risk in terms of entering a recession. So when you look at those key indicators that we have looked at, labor market softening, right? We are When you look at the yield curve, it's a bit inverted. There is an inversion in the yield curve. The fiscals look a bit weak, right? So and these kind of sentiments, they basically suggest a lot of vulnerability when it comes to now into a recession. So when you look at the government fiscal stress and recent shock, that is the shutdown, again it raises the stakes of entering a recession. All right. So but while some models basically show very high probabilities of a recession, for instance, the UBS is talking about 93% percent chances of a recession, right? Others are more moderate, like 40% of a recession. So what I may conclude on this is basically that a recession is not really guaranteed per se. All right, at the moment, a recession is not really guaranteed per se, but the probability is a bit elevated significantly above the normal timing, because of the depth and duration, which remains is highly uncertain. All right, what we are remaining now before the end of the year, the duration that we have before the end of the year, it's very uncertain. All right, and because of the government shutdown, we have not been able to receive such kind of data. We anticipate a bit slowness in terms of the US economy. But what I believe is, come next year, now that the government has reopened, I believe, or I anticipate to see a resurgent of the economy. Basically, seeing the economy now starts to expand, or the economy starts to grow. So I think for policymakers, investors, what is important to look at is to watch is the unemployment rate, right? So unemployment watch. What we need to watch is the impact of the unemployment rate in case it increases. We need to watch whether the yield curve remains inverted or steepness. We need also to monitor the consumer spending and income trends. We also need to monitor how the fiscal positions evolve, especially the interest cost, the budget deficits, and yeah, shock events like the geopolitical, the government policies, and the credit stress. It's very important for us to monitor that. Okay, so when now we look at, let's look also talk. Let me talk about also the government shutdown. We have been in a government shutdown, and just Wednesday is when the Congress voted 222 vis-a-vis out of 229, and we saw the government shutdown, which has been the longest in history, being able to end, and the president signing the bill, of course, to now ensure the funding is availed. Right. So now that we have had the government reopen, so what are the likely reactions in the market? So what we are likely to see, for instance, when you look at the US dollar, right? When you look at maybe probably the US dollar, so let me maybe share that chart for the US dollar. Okay, so let me pull a chart for the US dollar. Share screen. Huh. Share screen. So I'm sharing the entire screen. So this is the US dollar. We are looking at it on the daily time frame. So we have been seeing quite some weakness, but we are seeing some resurgent of the same. You see today being quite a bit bullish. But now, what am I looking at for the dollar index? So what my anticipation for the dollar index with the shutdown now being over, I'm looking at normal economic data flow now starting to come in, the jobs data, the inflation data, etc., which will now start resuming, and this will reduce one ambiguity factor that we have been having. Trading without the data has become, it's quite ambiguous, and I'm not anticipating any strong directional move. For me, I'll be just about a neutral to slightly weaker USD rather than a strong, a very strong lari for the dollar index. Okay, so and the reason why I'm looking at that is because if when data start being released, the US labor market consumption at the moment shows weaknesses. So then once the data comes in and split, the market might price a more dovish tone. All right, and more so, especially from the Federal Reserve, which is looking at cutting rates again by 25 basis points, and this could weigh on the dollar further. All right, so but my expectation is not that really um, a strong lari as per se, but I expect a neutral to slightly weaker dollar. Okay, so when you look at assets like gold, gold has its all-time high at 43.81. So when you look at assets like gold, when the government shut down, reopened on Wednesday, we are seeing some bearish tones here coming into place, and so with the reopening, what I'm looking at now is this: the risk premium associated with the shutdown will fade away, and that might reduce one reason to hold gold as a hedge. All right, so now it will not be a safe haven anymore, because it's one of the reason why, not that it will not be a safe haven, but it will be one of the reasons why maybe probably gold could not look people will not hold gold as an hedge. Okay, so on the flip side, if resumed data shows the signals or signs of slowdown, and thus increase rate cut hopes or a softer Fed stance, therefore we could see gold benefit again, because it means the dollar will weaken, and therefore we'll see gold benefit. So gold directional buyers will depend on the macro sub prices, and what you have said is a weak data, you will be able to see a tailwind, a strong data, potential headwind, right? So what I mean by tailwind is the dollar, what I mean by tailwind is pushing on the downside. Okay, I mean pushing on, because when we have a weaker data, what will happen is that the dollar will strength will weaken, and if the dollar weakens, then we are going to see a gold benefit. So in case we are going to see a strong dollar, then we are going to see the dollar strengthen, and therefore gold will likely to sell. Okay, so in summary, what I'm looking at is a tilt slightly positive for gold as a hedge, unless maybe probably the data might surprise on the upper side. Okay, so when you look at maybe indices and stocks market, so the reopening basically of the government acts as a relief. All right, it's actually a relief factor, especially for the indices and stocks. So bringing back the economic data means and reducing a tail risk of deep uncertainty. So these we might see the markets showing some signs of relief. Of course, you've been able to see some signs of relief. If you look at a stock like Johnson and Johnson, we have been seeing a Johnson and Johnson, actually it has already created an all-time high, right? So if you look at this Johnson and Johnson, it has already created an all-time high. If you look at some of the indices, maybe probably US 30, right? If you look at some of the indices, maybe probably the US 30. So what we are seeing is they had also created some all-time highs, all right, here. And yeah, so what I might say about the stocks and indices is basically that the broader equity market has upside. We have been seeing the upside of it, and this upside is basically, to me, modest, and it's vulnerable to weak data or policy surprises, all right, in terms of how the data is going to come out. So it will depend on how or where the market is going to go, right? So that's basically what I'm looking at, and let's maybe monitor that, and we will see. We'll be here to discuss the outcomes and the way forward. So I believe this was quite informative, and until next time, take care and have a lovely weekend.